Hey, it's Soleil, and this is episode 49 of the Red Pilled Orange Pill Investor. And yesterday I broke my streak of daily videos. Got a little busy, got a little sidetracked. I can make excuses, but I was working on some stuff and I was on call and got paged and whatnot. But this will be cool. The streak stopped at, I think, 49. So my goal is to do 350 videos this year, so that only accounts for 15 days off. Got a couple of vacations planned, and I guess I could do a couple of videos a day, and I could even have a couple extra days off. But market's closed today, so maybe it's a good thing. Probably didn't need 3 weekend updates for me to just talk about the market when the market's not even open. But you can always talk about Bitcoin because Bitcoin is always open. So that's just one more way that Bitcoin is going to disrupt the financial industry. There's no reason with the digital nature of our modern society why the stock market should only be trading during 9:30 to 4 hours. Kind of silly. It may as well just trade 24/7. I know they've got some assets or maybe some exchanges that are trading some things 24/7, but the liquidity sucks. And it's almost like Tesla disrupting the automotive industry. Bitcoin is basically coming in and saying, you've been doing the financial, you've been doing the stock market this way for 100 years without really innovating. And Bitcoin's like, let me show you how this shit is done. We're going to trade 24/7 in all areas of the world. And if you go to sleep, who knows what you'll wake up to the next day. So just to recap, I did have to switch some stuff around. Not really sure why my buying power jumped up. It was like $2,000 Friday at the close. Maybe certain things take a little while to settle. So maybe if you sell an asset, maybe Robinhood's not giving you full credit for having sold it until it settles a day or two later. I don't have any idea exactly how Robinhood's algorithm works. It seems like it's just really random. I mean, I had a bunch of buying power at one point, and they changed how much MicroStrategy counts against you. I think the maintenance requirement was much lower here, and then at some point I just had way less buying power, and it was like right before MicroStrategy's earnings too. Was it right after? No, I think it was right before earnings. And so maybe they were just getting spooked, like hey, people who are too leveraged with MicroStrategy, if the price crashes, either they were trying to, maybe I shouldn't be giving them too much credit. I almost said maybe they were trying to protect investors or themselves from being over leveraged on something as volatile as MicroStrategy on the day that they're going to announce earnings. But since that actually reduced our buying power, you could argue that they were trying to force people into a margin call. So who knows if Robinhood was being shady or proactive in that case. But anyway, this account just has MicroStrategy and Mara, and then one Tesla Leaps. When they cut my buying power down, I didn't want to get rid of my MicroStrategy shares, so I couldn't afford MicroStrategy and Tesla on this account. So I went ahead and just created a Leaps option, and so I grabbed the 150 strike for next January, and then that enables me to go ahead and sell some weekly calls. And the structure on this looks pretty good. The delta is around 0.3 on the weekly calls, and then the delta on the leaps is over 0.7. That's over 0.8 at this point. I think it was around 0.8 when I got it. It's increased slightly because it was like, yeah, I paid $6,000 for it, and now it's worth $6,900. So as the value of Tesla hopefully increases, the delta on this will also increase, and as it gets closer to 1, it more accurately represents a synthetic stock. So the whole point of buying a leaps is you can own this option, and it's about 80% of owning the shares, meaning the price of Tesla goes up $1, the price of this leaps goes up 82 cents. So it's not completely exactly a synthetic. You don't get 1 for 1, but at a third of the price, maybe not a third of the price. Oh yeah, actually less than a third of the price. So it would cost you $20,000 for 100 shares of Tesla, and it only cost you $6,000 for the leaps. Now this is much more dangerous. So I got wrecked at the end of 2 years ago. I was making a bunch of money with these poor man's covered calls when you combine the leaps with selling covered calls against it. Everything was working out great. But when the price of Tesla and the price of Bitcoin fell off a cliff, so from right here, everything was great up here, here, and then the price of Tesla started crashing from 400. So you could have a really deep in the money leaps at like the 200 strike and think you're very safe. You might have a 0.9 delta, a nice synthetic stock option. And then when the price drops to, doesn't have to drop that far, but once it drops to your strike price, now you can barely, if you paid a third of this $400 strike, so maybe you pay $13,000 for a leaps here, and once it drops, the price of Tesla drops to 230 or 200, the price, the $13,000 that you paid for that probably dropped down, I would say 75%. So the price of Tesla drops 50%, the price of that option is going to drop at least 75. So it's probably only worth about $4,000. Whereas if you just bought 100 shares, even if you fucked yourself and you bought Tesla at the top, when it drops to 200, you only lost half. But the value of that leaps is going to drop by 75% probably. And those are just ballpark figures. And then you're really screwed if the price of the stock drops below you cannot. There's no way in hell to configure a call option that you can sell against this. If you have a 200 strike leaps, there's no way you'll be able to get any premium at the 200 strike. So you can't even combine. Once you lose this much money on your leaps, you probably lost 90% of the value at this point. If Tesla drops 75%, your leaps lost 90%. It's all well and good if you buy your leaps here as it's going up, but leaps are very dangerous instruments. So I don't give financial advice anyway, but it can be a really bad deal if you buy up here. But I have it's not that I'm confident in the overall market. I mean, if we hit World War III, or who knows. Sometimes the stock market just doesn't give a shit. But even when we had COVID, we had that massive drop, and then it just rebounded. So as long as you don't get, excuse me, as long as you don't get wrecked, which is the risk of using margin. If you just don't use margin and you just don't buy options, if you just don't use margin and you just buy the shares, there's very little existential risk of getting completely screwed. You'd have to invest in something that went completely to zero. And I think Bitcoin and Tesla at this point have outgrown almost all of the existential threats that they face. So I'm not terribly worried about either of those instruments going to zero. And at the same time, the risk reward is off the charts. Stephen Mark Ryan likes to say that Tesla's the greatest risk-adjusted opportunity that he's aware of, something like that. He says he's looked at Bitcoin, but I don't understand how you can seriously study Bitcoin for any length of time and not come to the same conclusion. But he's built an entire brand around Tesla at this point, and it served him well in the social media space as well as an investment. So can't blame him for that. All right, I'm back on the wagon. This is like episode 49 or 50. I can't remember. But anyway, we'll start my streak over with one, and we'll see how many days in a row I can keep it going. All right, be good, Joe.